Today, we will take a closer look at Microsoft, the technology powerhouse behind Windows, Microsoft 365, Azure, LinkedIn, Xbox, and the rapidly expanding Copilot AI platform. In the second quarter of fiscal year 2026, Microsoft generated $81.3 billion in revenue, up 17% year-over-year, driven largely by continued strength in Azure and enterprise cloud services. Operating income reached $38.3 billion, highlighting solid operating leverage despite continued AI investment. Net income came in at $38.5 billion, and earnings per share totaled $4.14, slightly above market expectations, underscoring Microsoft's ability to translate growth into sustained profitability. This quarter clearly illustrates how Microsoft's revenue engine is evolving. Productivity and business processes remain the largest segment at $34.1 billion, growing 16%, supported by Microsoft 365, LinkedIn, and Dynamics 365. Intelligent Cloud followed closely with $32.9 billion, rising 29%, as Azure grew 31% to $30.9 billion, reflecting continued enterprise demand for cloud and AI workloads. In contrast, more personal computing generated $14.3 billion, down 3%, with weakness in Windows and Xbox partly offset by growth in search and advertising. The composition of revenue makes the shift clear. Microsoft's growth story is increasingly centered on cloud and AI. Now let's look at Microsoft's revenue trend over time. Total revenue has steadily increased from around $40 billion per quarter in 2021 to over $81 billion in Q2 FY26, showing consistent long-term expansion. However, it's important to note that starting in fiscal year 2025, Microsoft reclassified certain revenue streams, including the transition from Office to Microsoft 365. This slightly affects comparability across periods, but does not change the overall growth trajectory. More importantly, the structural shift is clear. Intelligent Cloud has expanded significantly over time, becoming a larger driver of total revenue, while productivity continues to grow steadily and more personal computing remains more cyclical. Overall, Microsoft's revenue base has become increasingly cloud-driven and enterprise-focused. Microsoft 365 commercial seats continue to expand, reaching 454 million in Q2 FY26. However, growth has moderated to around 6% year-over-year, compared to double-digit levels in prior years, reflecting high enterprise penetration. At this stage, the focus has clearly shifted from seat expansion to monetization. Commercial cloud revenue still grew in the mid-teens, supported by E5 upgrades and increasing adoption of Copilot across enterprise customers. In other words, user growth is slowing, but revenue per user continues to rise. On the consumer side, subscriptions increased to over 90 million, but growth has also slowed to roughly 6% year-over-year, down from nearly 20% several years ago. This indicates a maturing subscription base. However, revenue growth remains resilient, supported by pricing optimization and premium feature adoption. Overall, both commercial and consumer segments show the same structural trend: slower unit growth, but improving monetization, reinforcing Microsoft 365 as a stable, recurring revenue engine. LinkedIn's member base has expanded to over 1.3 billion users, while quarterly revenue reached approximately $5.1 billion, growing around 11% year-over-year. Over the long term, revenue has increased at a faster pace than user growth, indicating improving monetization per member. Notably, LinkedIn recently surpassed $2 billion in premium subscription revenue over a 12-month period, reinforcing the growing importance of recurring subscription income alongside advertising and recruitment services. Within its base of more than 1.3 billion members, LinkedIn maintains a highly diversified global presence. The US remains the largest market with over 220 million members, followed by India with more than 170 million, while countries such as Brazil and the UK each contribute tens of millions. This geographic diversification supports advertising and recruiting demand across regions, strengthening LinkedIn's long-term growth profile. Dynamics 365 operates in both the CRM and ERP markets, where Microsoft remains a growing challenger. In CRM, Salesforce leads with about 21% market share, while Microsoft holds roughly 5%. In ERP, Microsoft accounts for around 6 to 7%, competing with SAP and Oracle. The opportunity remains substantial. The CRM market is projected to grow at over 13% CAGR and ERP at around 10% CAGR, driven by cloud migration and AI adoption. In the latest quarter, Dynamics 365 grew in the high teens year over year, supported by integration with Azure, Microsoft 365, and Copilot. The broader cloud infrastructure market remains on a rapid growth path. In Q4 2025, global cloud infrastructure revenues reached approximately $119 billion, growing around 30% year over year, driven largely by AI workloads, advanced analytics, and enterprise cloud migrations. Within this expanding market, AWS holds about 28% share, slightly down from around 31% 2 years ago. Microsoft Azure has risen to roughly 21%, up from the high teens range, while Google Cloud stands at around 14%, continuing to expand gradually. According to Microsoft's latest earnings, Azure and other cloud services grew around 39% year over year, outpacing the overall market and indicating continued share gains. Management also noted that AI demand continues to exceed available capacity, prompting accelerated investment in data center and infrastructure expansion. In Q2 FY26, Windows' role within Microsoft's ecosystem remained resilient even as overall PC-oriented revenue moderated, with Windows OEM and devices revenue increasing modestly amid ongoing enterprise refresh cycles and upgrade demand ahead of Windows 10 end of support. This underlying demand is also reflected in market positioning. By the end of 2025, Windows held approximately 31% of global operating system market share, ranking second worldwide and recovering from earlier softness during the year. At the same time, the broader operating systems market is projected to grow from $47.6 billion in 2024 to $52.5 billion by 2029, implying a modest 2% CAGR, highlighting a mature but stable industry backdrop. Against this environment, Windows remains a foundational platform, anchoring the PC ecosystem while serving as a key gateway to Microsoft's cloud and AI services. Over the past few years, Microsoft's gaming business has shifted from hardware-driven cycles to a more content-led model. While console revenue remains volatile, content and services has become the core growth engine, supported by the ZeniMax and Activision acquisitions. In Q2 FY26, total gaming revenue declined about 9% year over year, mainly due to a 32% drop in Xbox hardware, while content and services fell around 5%, partly reflecting a lighter first-party release slate compared to last year. Despite near-term pressure, Game Pass and recurring digital revenue remains central to Microsoft's long-term gaming strategy, reinforcing the shift toward a services-driven ecosystem. The global digital advertising market is projected to reach $869 billion in 2026 and $944 billion in 2027, growing at a strong 11.4% CAGR, with Alphabet and Meta continuing to dominate overall ad spend. Within this expanding market, Microsoft generates around $19 billion in advertising revenue, primarily from Bing, $10.7 billion, and LinkedIn, $8.3 billion. In search, which represents roughly 29% of total digital ad spend, Bing holds about 4.4% global market share in 2026, with stronger share in desktop environments. Looking ahead, Microsoft expects its search and advertising business to benefit from continued AI integration, Copilot-enhanced search experiences, and deeper ecosystem integration across Windows, Edge, and Microsoft 365, supporting gradual monetization improvement and steady long-term growth. ChatGPT currently leads the AI assistant market with around 815 million active users, maintaining roughly 74 to 76% share of total AI web visits. Monthly traffic climbed from under 2 billion in early 2024 to over 6 billion at its peak in late 2025, before stabilizing above 5.5 billion, indicating sustained engagement rather than short-term hype. Microsoft's Copilot ecosystem follows a different trajectory. Copilot has approximately 103 million active users, while GitHub Copilot serves 4.7 million paid developers, and Microsoft 365 Copilot has reached 15 million paid licenses. In short, ChatGPT dominates in consumer reach and traffic share, whereas Microsoft Copilot strategy is increasingly centered on paid enterprise adoption, workflow integration, and recurring revenue expansion rather than pure web visit scale alone. Looking ahead to 2026 to 2028, Microsoft's AI strategy rests on three pillars: monetization, infrastructure scale, and ecosystem control. Copilot currently delivers $5.4 billion ARR from 15 million paid licenses, only 3.3% penetration across 450M Microsoft 365 commercial users. If penetration rises to 10 to 20%, ARR could scale to $16, $30B+, making Copilot a major revenue engine rather than a feature add-on. On the cloud side, Azure AI is running at roughly a $26 billion revenue run rate, growing 30 to 40% YOY, serving 250-plus enterprise AI customers and processing over 1 trillion tokens annually. However, this growth requires around $100 billion in annual CapEx, with two-thirds allocated to GPU/CPU infrastructure. At the same time, margins face pressure. Cloud gross margin near 67% could drift toward 65% as AI inference introduces real compute costs. Add to that regulatory scrutiny and OpenAI exposure. 45% of $625 billion RPO linked to OpenAI, and a strategic question becomes clear. Can Microsoft convert unprecedented AI investment into long-term platform dominance and sustained AI revenue expansion? Microsoft's operating income has risen from about $26.9 billion in Q1 24 to $38.3 billion in Q2 26, reflecting sustained growth and operating leverage. Starting in fiscal year 2025, Microsoft reclassified certain revenue streams, including the shift from Office to Microsoft 365, which changed segment reporting and the operating income mix. As a result, productivity became the largest contributor, reaching $20.6 billion in operating income in Q2 FY26, with operating margin holding in the 53–60% range. Meanwhile, Intelligent Cloud operating income reached $13.9 billion in Q2 FY26, with margins remaining solid at around 42%, despite higher AI infrastructure investments. In contrast, more personal computing contributed $3.8 billion, with margins in the mid-20% range, reflecting its more cyclical and lower margin profile. Microsoft's operating expenses have increased steadily, with the fastest growth coming from research and development, expanding at roughly 10% CAGR. By Q2 2026, research and development reached about $8.5 billion, reflecting continued investment in AI and cloud innovation. Selling and marketing expenses were around $6.6 billion, growing more moderately at about 5% CAGR, while general and administrative expenses increased at roughly 8% CAGR. This trend shows Microsoft prioritizing technology and AI investment, while keeping operating structure relatively disciplined. Alongside steady revenue growth, Microsoft's net income has also improved significantly. Net income increased from roughly $16 to $22 billion during 2022 to 2023 to $38.5 billion in Q2 2026, indicating accelerating profitability. At the same time, net margin which had fluctuated in the 31 to 37% range through 2023 to 2025, expanded sharply to 47.4% in Q2 2026, reflecting stronger operating leverage and improved efficiency as cloud and AI scale. From fiscal year 2022 through fiscal year 2026, Microsoft's revenue has expanded steadily and largely aligned with market expectations, reflecting durable demand across Azure, Microsoft 365, and AI-driven services. Consensus estimates project full-year revenue to reach roughly $328 billion in fiscal 2026, rising toward around $378 billion in fiscal 2027, supported by continued cloud growth and Copilot monetization. Earnings per share have remained resilient and, in recent quarters, have modestly exceeded consensus expectations, supported by operating leverage from high-margin cloud and software segments. Annual EPS is projected to approach around $17 in fiscal 2026 and trend toward $19 in fiscal 2027, even as capital expenditures remain elevated to support AI infrastructure expansion. While Microsoft continues to deliver solid revenue and earnings growth, its share price has not kept pace, falling roughly 40% from its recent peak. The decline reflects broader market volatility, valuation compression across large-cap technology stocks, and investor caution surrounding elevated AI capital expenditures rather than a deterioration in fundamentals. Despite recent market volatility, analyst sentiment remains broadly positive. Based on consensus from 49 analysts, the average 12-month price target stands at approximately $594.91, implying about 51% upside from the current price near $392.74. The bull case reaches $730, while the bear case is around $392, suggesting a favorable risk-reward profile. Analyst ratings continue to reflect a prevailing strong buy stance, underscoring institutional confidence in Microsoft's long-term AI-driven earnings trajectory. Thank you for watching. The information presented in this video reflects opinions at the time of publication, is based on sources believed to be reliable, and is provided for informational purposes only. It does not constitute investment advice or recommendation.